Yeah,
So
Geoff, take
here,
us through some other options that are out there in addition to the Treasury bills that I alluded to for fairly short term.
yeah. So we touched on the Treasury. Um, the Treasury holds auctions, and it's really what allows them to raise capital. The money market we've touched on. We haven't really focused in a finite matter. There are several different types of money markets, which we'll get into on the slides to come. CDs, I mean, certificate of deposit. It's typically issued by a bank. There's bank issued CDs, and then there's brokered CDs. CDs are typically you're taking liquidity risk,
Hmm.
anywhere from 6 months to 10 years. And the yield curve with CDs is similar to that of treasuries. I mean, treasuries tend to be the benchmark by which CDs and other structures like that are issuing their debt. So typically when you buy a longer term CD, you would hope to be paid a higher interest, and that's
Yep.
just not the case in this environment. And then we've got zero coupon bonds, which many may not realize that they know what a zero coupon bond is, because back in the day it was pretty popular to buy a savings bond for the birth of a new child. You buy
Hmm.
a zero coupon bond or a savings bond at a local bank, or I believe Treasury Direct is where zero coupon bonds can be purchased today. Think of it this way: you buy it for $50, it matures at $100 at a set period of time. No interest payments. You're basically buying it at a discount, and
Hmm.
at a set maturity date, you will have double your investment. Now, I've run into a lot of clients, or typically it's a client's parent passes away, and as they're organizing their estate, they find savings bonds that matured 10, 15 years ago. Well, when they mature, there's no more future growth. So that's even worse than, having money in the bank in cash that's maybe yielding, a quarter of a percent. It's you're giving up all future growth if you do not cash in that savings bond or that zero coupon bond when it matures. So again, it's important to know what you own, know what you have in your portfolio or under the hood of your financial plan.
Hmm.
Anything to add there?
No, just CDs. You mentioned liquidity risk, but there's also interest rate risk there as well. So if you buy a 1-year CD, you're buying it at current rates. So if interest rates decrease between now and when that CD matures, likely that's going to be beneficial for you, at least in terms of opportunity basis, where you bought a CD at a higher interest rate, it matures, and if you redeploy it, you're redeploying it at a lower interest rate. It could work against you, and that's what investors have seen, that if we're in a rising interest rate environment, you purchase a CD today, interest rates rise. If you hung on a little bit, you could have bought a CD that's going to yield and generate a higher return. So the liquidity risk is selling that CD. You're giving up some of that return via a penalty by exiting. But when you purchase a CD, when you purchase a bond, you're taking on some interest rate risk, because those rates are going to be moving. They could move in your favor, or they could move against your favor. So something to note that with CDs, bonds, etc., you got liquidity risk. You're also taking on some interest rate risk as well.
One thing additional on the CD front, I've heard from many that they don't want to sell a CD because of the penalty. I mean, in reality, they call it a penalty. Really, you're giving up the interest from when interest last paid. So if you own a 5-year CD that pays interest quarterly or semi-annually,
Right.
you're and you liquidate if it pays semi-annually and you liquidate after 5 months, in May, then you're giving up that first 5 months of the year worth of interest. But at the midway point through the year, you've got full ability to liquidate, and the penalty is zero, or the interest that you're giving back is zero. So again, know the structure. And
No, I'm glad you
again,
brought that up too, because that's a prime example. That's been done. Investors purchased 5-year CDs several years ago, and that 5-year CD, even though you're giving up liquidity for 5 years, that's got a lot more interest rate risk than buying a 1-year CD. And that 5-year CD, maybe let's say, was paying you 3%. Well, it's got to be painful to see that you're stuck holding this CD for maybe another 2 or 3 years. Yeah, you could buy a 1 year CD today and get basically 5. So that's an example right then and there of interest rate risk, and why, to Geoff, to your point, you should evaluate that CD. If I exit early, what is the penalty, or what am I giving up? Because maybe I can redeploy it and generate a higher yield. What's the break even on that decision? That's something we can certainly help with. But that's what's taken place. A lot of investors that loaded up with longer term bonds and then saw interest rates increase are sitting there saying, man, I don't want this bond. I'd rather it mature so I can take it, redeploy it, and purchase a newer bond at a higher interest rate. So it's the environment that we're currently in, hence the need to take a look at what you own and what options are available.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.